Dear clients, welcome to PhillipCapital's Weekly Market Watch. My name is Nicholas Ong, investment analyst from Phillip Securities Research. This week, we'll be talking about crude palm oil. Let us first take a look at the demand side of the equation. We can see that Malaysia palm oil inventory started to rise in September to 1.8 million tons, 7% above the previous month's 1.7 million tons level on seasonal factors. Stock levels have remained below 2 million tons for the 6th consecutive month, which we believe is supportive of CPO pricing. Export seems pretty robust as the numbers rose by 6% year-on-year to 1.6 million tons on high demand from India, the largest importer of crude palm oil. In addition, cargo surveyor Intertech recently reported a 17% year-on-year growth in CPO exports for the first 10 days in October compared with the same period last year. That said, we believe that stock levels should continue to rise over the coming months as palm oil production typically peaks in November. Let us now take a look at the supply side of the equation. Malaysia's September CPO production declined 5% year-on-year to 1.9 million tons, but continues to grow for the 7th consecutive month by 10% month-on-month as we enter into the seasonally high production period. In addition, cumulative year to September production this year is still 4% higher as compared to that in the previous year, indicating that biological slowdown has a less impact on plantation estates in Malaysia. In our view, on the other hand, we see weaker CPO production over at Indonesia in second quarter this year due to palm tree stress following the bumper harvest last year. We believe the lower growth in Indonesia should also provide support to CPO prices in the near term. Last but not least, let us take a look at the substitutes of crude palm oil. Based on USDA projections in September, we estimate that the stock-to-usage ratio of global vegetable oils, including palm, soybean, rapeseed oil, in 2013-14 is 13% versus 12.2% in 2012-13. This rise in stock-to-usage ratio indicates supply alleviation for global vegetable oils, in particular for soybean crop, due to bumper harvests from both US and Brazil. Hence, soybean prices will likely to be dampened in the second half of this year and first half of next year, dragging down CPO prices too. In addition, CPO is currently trading at $160 per metric ton, discount to soybean oil from a peak of more than $300 per metric ton. This is way below its historical long-term average of $205 per metric ton on lower soybean prices. Hence, we think this is no longer a catalyst for CPO demand. All in all, we believe CPO prices will remain muted in the second half of this year based on 3 reasons. 1. Steady production growth from Malaysia. 2. Anticipated higher supply of vegetable oil such as soybean and rapeseed oil, which are substitutes of palm oil. And 3. Weaker Indian rupee against the US dollars affecting demand from India. All this, coupled with the seasonally peak production period, would cap any upside recovery on CPO prices in the near term. In view of this, we believe that it is still too early to buy pure upstream plantation stocks as the sector is still lacking positive catalysts. We continue to like Wilmar for its positive long-term fundamentals as it remains a good proxy for the growing food demand in China and Southeast Asia. That's all we have today. Do stay tuned to next week's video. Thank you.